Welcome to Fun with Annuities with your host, me, Stan the Annuity Man, America's annuity agent. Can annuities be fun? Can contractual guarantees be fun? Absolutely they can. Find out the brutal facts about annuities with no sales pitches or high-pressure nonsense. Just the brutal and factual annuity truth, which is all you need to hear. Let's have some fun with annuities, and let's have that fun start right now. Welcome to Fun with Annuities. I'm your host, Stan the Annuity Man, America's annuity agent, licensed in all 50 states. Welcome to all the podcast listeners. And of course, I have a Fun with Annuities YouTube channel that you can watch me and my facial expressions and all of the gear that I have on. I'm rocking the blue today for the podcast listeners. Great guest today. His name is John Lenz, personal friend of mine, but an absolute guru when it comes to life insurance and annuities. And he's the founder of Lenz Financial, but I'm going to let him tell you a little bit about himself because there's not many people in the annuity industry that's been doing it longer than I have, and I've been at 3 decades. John is at the 4 decades level, so that's pretty good. So welcome, John Lenz. Tell everybody about yourself.
Hey, Stan. Enough about me. Let's talk about you.
No.
This is year 41 for me. I used to be the young guy in the room like you did, and now I'm just an old, experienced warhorse. If I had to describe myself, I'd say I was an annuity mechanic. I don't know really much about anything else, but I have been lucky to work around annuities on the design side, distribution side. I'm a consumer of an annuity, 1, 2, 3 annuities for my own retirement plan. And annuities are pretty boring, as you know. They only go up and sideways, the good ones.
Right.
And so, what I've tried to do is expand my annuity base into things that are a little outside the 9-dot box. I know you've covered a lot of that, so I'm looking forward today to talking about some of the interesting ways that annuities can be used, especially for people who can't manage money.
And we're going to do something a little different because obviously I do a lot of content. People that are familiar with me, I've got hundreds and hundreds of videos on the Stan the Annuity Man YouTube channel. I've written 400 articles. I've written 7 books. And all of the stuff that I do is really making annuities simple, and they should be because they're contracts and you should buy them for the contractual guarantees. What I like about what John is doing is it's really some advanced planning stuff, really heady stuff, but it's still all contractual. It's not pie in the sky. It's not unicorns chasing the butterflies. You know, it is outside the box thinking that we're gonna go over some examples. Let's talk about let's get into the first one, which is called spendthrift planning, which most people aren't familiar with. So take us down a notch from your IQ, John Lenz, and explain spendthrift planning and maybe an example or two, so if the listeners it makes sense to them, they can connect with you.
Sure. Well, thanks. Spendthrift is a fancy word for someone who's not really great with money. And there's certainly plenty of those people running around, including me at times in my life.
Yeah.
So, I get calls occasionally from advisors like yourself or attorneys, people who may find themselves unexpectedly as an executor or executrix of an estate or a trustee, and they've got somebody who's a beneficiary who's really not very good with money. And I'll start with a case you and I talked a little bit about, but I was on the phone with a gentleman. He was 75 years old, lived in California, a really good guy. I mean, just the salt of the earth guy. And I was on with his advisor and his attorney. And we got to know each other a little bit. Excuse me. And he said, John, I said, it's been a great life. I'm 75 years old and I'm probably not going to see my 76th birthday. And he was very pragmatic and not too worried about it. He said, I've got pancreatic cancer. It's going to kill me, and it's probably going to kill me within a few months. He said, I'm divorced, not in touch with my ex-wife. I've got 1 kid. He's 55 years old and the love of my life. And besides gambling, alcohol, drugs, fast cars, and fast women, he is a super great kid. And he paused, and I said, yeah, he sounds like my kind of guy.
Absolutely.
And he said, he is a great kid, but I'm going to leave him about $700,000. And if I leave it to him in a lump sum, he will, can't really swear on the Stan the Annuity Man YouTube channel, right? But he's going to fritter it away
Yeah.
in a short period of time. And I'm worried about him. I'm actually more worried about handing him my loaded gun than I am this much money, because I just don't know what's going to happen to him.
Yeah,
So
I hold that for thought. I call this, and people that listen to me know, this is called lovingly handcuffing your beneficiaries. That's really what you're doing, is you're contractually handcuffing them to not fly in on a helicopter to your funeral and get in a Lamborghini that they bought with cash. I mean,
yeah.
That's what you're doing. So go forward with what we're doing with this handcuffing and spendthrift planning.
Sure. Well, one of the obvious options, this gentleman was a lawyer, and he could have set up a trust, hired a trustee, put this money in there, and then had the trustee dole the money out to the spendthrift child over a period of years. He could have put in their sobriety test or employment, qualifications. But he realized that, that's going to eat up the trust balance at, 1% a year or more. Then the son could hire his own lawyer and demand a lump sum.
Sure.
So what he decided to do, he was talking to, again, his attorney and his advisor and I, and what we set up was an income stream for his son that would go into effect either at the dad's death or prior to his death. And we looked at both options. What we ended up doing was creating a 25-year income stream for the kid before dad died. We did that so that the policy, the annuity, the immediate annuity payment stream would be seasoned and irrevocable, non-commutable, non-surrenderable. It couldn't sell them to late night TV. It's your money, you want it now, people. Right?
Exactly.
All he's going to do is get a check for about $2,500 or $2,600 a month for most of the rest of his life. And I'll tell you, everybody was super happy. The son didn't know anything about it, didn't know about his dad's net worth. And when dad died, which he did, those payments went to the son. And I don't know, I guess he can gamble and run around with drugs and alcohol, but only at $2,500 a month.
Yeah, but on a monthly stipend. I always say that, and there's a lot of listeners and viewers out there that are saying, yes, I have those wondering ambiguities of children that either are the musician types, and I can say that because I'm a musician. Thank goodness that wouldn't pay the bills. But the point is, you can set something up to where you're controlling it from the grave, but it's not like you're a control freak. You're lovingly controlling it and really saving them from themselves. Correct?
Yeah. Well, I mean, I know we like to joke around a little bit, but giving somebody that amount of money that's not good with money,
yeah,
it's not a good formula. I mean, in all seriousness, the corollary to this is a more typical case where there's more than one kid. And it's typically the good daughter and, again, the son that's got some of those problems. And their mom and dad have got a living trust. They've named good daughter as the trustee.
Right.
And all of a sudden, her money's available in a lump sum, but they want the income stream settled to the boy. Right. Well, think about the sibling problems that creates when you leave the little sister in charge of big ugly brother's money. I didn't mean to say ugly. Big brother's money, and now all of a sudden things can get ugly between siblings.
How do you do that one? Like give me an example of the multiple, brother sister or brother sister, and how do you do that so that they're not throwing haymakers at the funeral at each other?
Yeah, usually it's after the funeral when the trust is reviewed, and dad's gone. And I mean, think about it as you've got kids, right? And so do I. The last thing I want at my funeral is for my children to be bickering with each other over money, and money brings out the worst in people, right? It's just the way it is. So there's a couple of strategies there. Not everybody wants to buy an irrevocable income stream during their lifetime. So a person in their trust can instruct the trustee to purchase an immediate annuity which is a payment stream, right? To the
Mm-hmm.
for the spendthrift beneficiary, the beneficiary of the trust, that would start after the death of the grantor of the trust.
Right.
So that's usually how we'll do that. The other thing we do when a trust is not involved is have an insurance company use their form that says, when John dies, his son, I've got sons, Jason, David, and Ryan, and Jason and David can have their money in a lump sum, but Ryan is restricted to taking his money out over a 15-year period.
Wow.
And many really great insurance companies can put that language in their contract. So that's the only option. It's a payment stream.
And people need to remember, and I say this all the time, annuities are contracts. And so, you can use those contracts and customize those contracts to achieve the specific goals that you have in mind. Talking about lawyers for a minute, I don't like to talk about lawyers a lot, even though some of them are my best friends in the world. What type of lawyer? Like someone says, okay, I want to put together this trust. Are they looking for an estate planning lawyer? Are they looking for a tax lawyer? What kind of lawyer are they looking for?
Yeah, I'd say an estate planning attorney is probably the person that gets involved in this. Occasionally, this is done with where somebody goes into, say, an attorney that handles special needs trust.
Yeah.
This isn't always about a kid that just doesn't know how to manage money. It could be about a child that just doesn't have the mental wherewithal to handle the money. And so an annuity can serve as a trust, poor man's trust. I mean, you don't have to write a trust to buy an annuity or to use an annuity in a situation like this.
Give me an example. I get occasional calls and they're tragic of the child that is either has been in an accident or is handicapped, special needs, and the parents really want to take care of them when they're gone. And it's such an important, it's just the biggest checkbox they have. Give us some examples of how that might work. And it probably correlates with what you just said, but maybe you have a case that you've dealt with.
Yeah, so I'm working on a case right now where there's two, the couple is about 68, 69 years old.
Mm-hmm.
They married later in life. They had their children later in life. And tragically, their two children are both autistic. The boys are in their mid-20s now.
Okay.
I mean, that may or may not have had anything to do with when they got married. But again, boys are in their mid-20s. They are able to work at a very low level, minimum wage. Not really manage money, and the parents are 40 years older than the boys. So obviously these boys are going to be without their financial support at some point. So these parents have entered into planning mode big time. They're loving people. They took on the responsibility. They brought these kids into the world, and he was in the medical profession, so he had pretty good income. Mm-hmm. So he's retired. First thing they did is they own some life insurance, and then they have a trust that instructs the trustee to purchase annuities for the lifetime payment of both of these boys.
Okay.
So they've set aside assets and insurance and instructions in a trust so that the trustee will purchase life insurance on the lifetime of each of the boys, so that no matter how long those boys live, they'll have an income. These people were extra smart. They realized that these boys might live 40 years without them, and inflation is an issue. We've talked about that. Inflation is certainly a knock on an annuity payment stream.
Sure.
So part of these annuities we set up as inflation protected annuities. So the price of the annual payment on the annuity or monthly payment goes up 2 to 3% per year for the rest of their life, no matter how long they live. So that gives an ever increasing income stream.
And I address inflation all the time. No one really knows. And if they tell you they know, they don't. Annuity income streams can be increased contractually by just saying, I want this cost of living adjustment, COLA, to increase by 2% per year, or you can choose 3% per year. Now, the annuity companies have the big buildings for a reason. They don't give that away. They ratchet down those payments. But if you do want to address inflation, and in this specific situation for because of their age, it does make sense. Let's pivot. So that's the spendthrift planning, what I call lovingly handcuffing your beneficiaries planning, or taking care of your kids are beneficiaries or someone that is bad with money. I just did a case recently where it was the sister of a 75-year-old, and she was a 72-year-old sister, and put together something for her because she spent whatever she had.
Yeah.
And that was it. So it doesn't have to be kids. It can be grown-ups that are going to Vegas every weekend, etc.
Grown-ups are just kids, right?
Yeah.
In old bodies, and there's nothing magical about the ability to manage money. It's hard. Big lump sums of money run through people's fingers. I mean, look at the data on lottery winners. You take that money in a lump sum, and you're out of dough in 5 years, and a lot of bankruptcies. People who take it over time, much happier.
Professional athletes are the same way. It's just, and with the transfer of wealth that's getting ready to happen with all of these baby boomers getting older and 10,000 of them turning 65 every single day, there's going to be these issues, these planning issues are a big thing. Let's pivot to Medicaid planning. I really want you to dig in, because I get a lot of these calls, and of course our friends in DC are always toying with taxing the rich, and I always tell my listeners that if you don't think you're the evil rich, think again.
Right.
You are the evil rich. So let's dig in and give us some examples of Medicaid planning using annuities and how that works.
Sure. Well, it's a big topic, and we could spend an hour talking about it and not have covered all the nuances. So, it'll take a few minutes, but Medicaid is not the evil rich. Medicaid planning is really for modest people, almost always couples. And it's in the most tragic time of their life. A typical case is dad's 80, mom's 76, 77 years old. She's been taking care of dad, who's been forgetful of where his car keys are, and then pretty soon he's forgetful of names, and then he's diagnosed with dementia, and then he's got Alzheimer's, and he can't be taken care of at home anymore.
Right.
But physically he's strong, and his dad had Alzheimer's and lived into his 90s. So what this couple's facing is $8,000 to $10,000 to $12,000 a month, depending on where you live, in a memory care unit.
Yeah.
And this couple that we worked on had about $500,000 in assets. And if you divide, $10,000 a month into that, you can see that you're going to run out of money. And now you have a couple that had planned on a happy retirement and their golden years, and dad can't remember mom's name and doesn't know that they're spending $10,000 a month until she's in the poorhouse.
Right.
So, Medicaid is, the federal government program administered by the states to take care of people in that situation who find themselves in a nursing home with no money. And the vast majority of nursing home bills are paid by Medicaid. Now, there's private pay nursing home insurance, and then people pay out of their pocket. But once their pocketbook is empty, or in the case of couples, in 2021, you can keep assets of $130,380, I believe. And again, you asked about attorneys earlier. This is not a do it at home yourself task. This is an elder care attorney task. So you engage an elder care attorney who looks at all of your assets and said, okay, you've got an IRA, you've got some money in a brokerage account, you have an annuity, you've got money in a checkbook, you own your home, you own a car, and Medicaid has a very specific formula. One of the things that they will let you do in this married couple situation is to take some of your liquid assets and buy an immediate annuity for the life expectancy of the well spouse. In this case, mom, who's, say, 76 years old, she might be able to buy an annuity for a 15-year period certain. And for that 15 years, she'll get monthly payments that Medicaid won't touch. And they'll allow her to buy this annuity with all the money over $130,000, create an income stream for mom, preserving her financial dignity. And then Medicaid can pick up the tab for dad. So it's a very interesting niche in the Medicaid planning space. But Google it and you can see attorneys all across the country utilizing this strategy, because you can't give your money away. You can't give it to charity. You can't give it to your kids. That disqualifies you for receiving Medicaid benefits.
Is it typically the period certain annuity for our listeners? A period certain immediate annuity is you choose a specific period of time, say 15 years, it's going to pay you or somebody that you list as beneficiaries for 15 years. If you died in year 10, there's 5 more years of payments to the beneficiary. You can set it up 15 years, 17 years, 30 years, 20 years, whatever. It's a commodity quote. Is that typically the structure that's used as opposed to a lifetime income guaranteed immediate annuity?
Yeah, that's a great question. And it's a common misconception. A lot of people think of annuities when they think about life expectancy is that annuity is going to last no matter how long they live. That kind of annuity does not qualify in the Medicaid spend down world. What you have
So
to do
lifetime
is
income immediate annuities do not qualify, is what you're
that's
saying
right.
in the Medicaid. Okay.
That's right. So the Social Security puts up a table they update every year or so. And again, you can find this online and search for Social Security life expectancy calculator, enter your date of birth, and it'll come up with a months or years and months of life expectancy. Unless you got a minute to spend about life expectancy.
Sure.
It's a common misconception. I mean, life expectancy is not how long you're going to live. Yeah, it's a chart, an estimation of how long a group of people will live on average. So we take this 76-year-old person and take 100 of them, and if the life expectancy in this IRS table is 16 years, we would expect 16 people to have died and 16 people still to be living. So the Medicaid plan requires a period certain annuity not to exceed the tabular life expectancy. So it does not go forever. It goes for a certain number of years.
Okay.
So once you buy that annuity, it disappears from your Medicaid balance sheet.
Okay.
Mom, in this case, can reaccumulate the money without being disqualified for Medicaid. So she could rebuild her retirement account. And when dad does pass eventually, she's on her feet.
And I think this is where people get into problems, and agents who pose as estate planning and elder care lawyers when they shouldn't, or CPAs. That's where the problems happen. You just explain how to set it up properly under the legal guidelines. What happens if Johnny Agent, who wants to do it all himself and not have the clients talk to a lawyer, and sets up a lifetime income stream annuity to try to solve for Medicaid, this Medicaid planning? What happens then? Is that a problem?
Yeah, it does happen. So in real life, what happens is people hear about the idea, they buy an annuity, and then they go into Medicaid and they say, oh, hey, we have 130,000 in this annuity. The Medicaid caseworker opens the annuity contract and said, oh, this annuity does not have the required language that makes it invisible to Medicaid. And that language says that the annuity has to be non-cancelable, non-surrenderable, non-commutable, meaning you can't exchange it for a lump sum, has no cash surrender value, and the payee cannot be changed, and it has to be for the right life expectancy. So what happens is people go into Medicaid and they deliver a non-qualifying annuity policy, and Medicaid has to turn them away and say, I'm sorry, this is an asset, and so you need to go sell this to somebody or discount it or get your money back, spend it down, and then come back.
And with all immediate annuities and annuities for lifetime income and annuities in general, you shop all carriers for the highest contractual guarantee at that specific time. And as I tell people, annuity quotes are like a gallon of milk. They expire every 7 to 10 days unless you lock them in through the application process. So, when you're doing a period certain quote and you have gone through the elder care attorney for this Medicaid type planning, just make sure you're using either someone like myself, someone like John that's quoting all carriers to find the highest contractual guarantee, for the situation. Period certain annuity quotes, John, it's not a life expectancy type quote. It has to do with interest rates, correct?
Yeah. Annuities are income insurance, right? I mean,
correct.
We know annuities don't necessarily provide the highest rate of return to people, but because high rates of return come with commensurate high risk.
Sure.
So an immediate annuity is a structured payment. It can be, in the Medicaid planning world, it's always for a period of years, 8 years, 7 months, because that is the life expectancy of a 78 or 80 year old person.
Sure.
So for most people, and when you think about, backing up a step to the spendthrift planning, you could do life contingent options, meaning if a person lives beyond that 10-year, 20-year, 30-year period that the payment keeps going. Lots of insurance companies that I work with are paying, hundreds of checks every month to people who are 100 years old.
Sure.
I mean, they have beat the insurance company at their own game.
Yeah, and it's a transfer of risk, and the benefit proposition is as long as you are breathing with a lifetime income
Right.
stream annuity contract, they're going to pay you. And I always tell people there's no ROI until you die, because up until then it's a pure transfer of risk. So I think with the Medicaid planning, I get a lot of those calls. I think it's just key for our listeners and viewers to understand this is not do it yourself. This is an annuity Home Depot right here. This is, you need to engage, hold your nose if you don't want to deal with lawyers, but estate planning lawyers, elder care lawyers, these are people that are part social worker, part philanthropist. I mean, they're the ones that I've run into are fantastic, and they love helping and solving the problems and doing it right, because what you don't want to do is do it yourself and do it wrong, and then it's just a mess for not only you and your family. So that's a topic obviously we want to dig into later, and John will be on the program numerous times. By the way, his website is Lenz Financial, and Lenz is Lenz, lenzfinancial.com. I would go there if you want to speak with John, if you have an advanced case that you would like for him and his team to work on. They will certainly do that, and we certainly send him these advanced cases because John's done it for 40 years, man. He's seen it and done it. I don't think he's been to every single annuity rodeo imaginable. Let's pivot and let's talk about something that I guess coincides a little bit with spendthrift planning, or lovingly handcuffing your beneficiaries. And that would be adding a restrictive beneficiary payout. You've kind of covered it a little bit, but dig in deeper on some examples of that, because I'm assuming there's a lot of our viewers and listeners that have a beneficiary in mind, whether it's a son, daughter, cousin, whoever, that they want to control it a little bit.
Sure. And I'll go a little further as you're talking. It reminded me of using an annuity to make charitable bequests annually.
There you go. Yeah, do that.
So we've been talking mostly about annuity payments, right? Structured payments, but a lot of people would rather have accumulation during, while they're alive, and the structured payment to their beneficiaries when they're deceased. So you can purchase a multi-year guaranteed annuity with a quality company and a high interest rate. Well, high interest rate.
Let's explain that real quick. Multi-year guarantee annuities for the people that don't know that are listening. This is the annuity industry's version of a CD. It's a fixed rate for a specific period of time. You can buy them as short term as 2 years at the time of this taping. If you go to theannuityman.com, I have a live feed and we list all of them. You can take a look. You don't have to sign up. You just go there. So go with the MIGAs now that people know what they are.
So the couple now, let's say mom and dad are alive and they've got their son and daughter, where one of them is really good with money and one's really not. And they're contemplating, their estate plan and, end of life planning, which is certainly a great idea. Once you get into your 60s and 70s, I mean, stuff happens, right? We're all on that train together. But mom and dad are not interested in an annuity income stream now for them, because they don't need the income. They've got Social Security, other income sources. They want to accumulate money, and maybe this money's in an IRA. They want some safety and growth, but they're only taking out the required minimum distribution. So you can put that annuity or IRA with an insurance company that has a specific form that you complete during your lifetime, which, by the way, is changeable as long as you have sound mind. You change it right up to the date of your death. And you can put in the contract, pay the annuity to my son, John, in 20 equal installments upon my death, and allow for no lump sum or change of payee.
You can put that in the contract, no lump sum.
Right in the contract. Now, not everybody does that, but some really good companies are excellent at that. They've got a complete form, and you design it. You can say, I want it for 10 years, I want 20 years, I want it for their lifetime. And you can even nominate a secondary beneficiary. So lots of real interesting options using accumulation annuities like the MIGA, multi-year guarantee annuity,
Hmm.
or other types of annuities, and have restrictive beneficiary designations.
Yeah, I think people underestimate the flexibility of the customization of annuities. There's so much bad information and bad advertising. I hate all annuities. It's like saying you hate all restaurants.
Right.
It's
Yeah.
just dumb. But people have fallen for that, and they also, a lot of the people out there think, well, I'm never going to buy an annuity because when I die, the evil annuity company keeps the money. Of course, that is absolutely not true. That only describes one way to structure one, a lifetime income stream annuity. But most of the lifetime income streams that we do here at theannuityman.com is a lifetime income stream. But if your Learjet hits the mountain, we structure it so that 100% of the money
Right.
goes to the beneficiaries, and the evil annuity company doesn't keep a penny. I think one of the things that I want people to take away from what John's saying is think outside the box. If you have a situation that you want to contractually take care of, and I hate to say control from the grave or be a control freak, but there are times that that's needed. There are times that, I mean, my personal situation, I have two daughters that are in their 20s. They're, college-ish, college graduates. One's a dancer, one's a writer. Okay. I have to set up these type of situations for them in lifetime income streams because they might not ever make a lot of money. And when I die, I want to make sure that they're going to get that lifetime income stream. I'm a prime example of that. Um, One other item I want to, maybe we have time for a couple, but um, you were talking to me the other day about a really interesting idea. It was an immediate annuity. It was a stretch situation. It was
Yeah.
for non-IRAs. Give us, that one was a very intriguing one, especially with the way tax laws are changing. Give us an example of what that is. You might have already coined a phrase for what that is, but it's stretching non-qualified annuities. Am I correct?
Yeah, yeah. I wish I could take credit for that, the coinage, but no, it's a non-qualified stretch. The IRS has looked favorably on that now for I don't know, less than 10 years, but it's widely used in the insurance industry.
Okay.
There's $2 trillion of annuity deposits estimated right now, accumulating interest safely for people across the country. All those people are going to die someday,
Mm-hmm.
and lots of these annuities have big gains built up. So unlike stocks and real estate, where the basis is stepped up to the value at death, annuities transfer over to the beneficiaries as income in respect of a decedent, right? And it's going to be ordinary income when the beneficiary takes it out.
Mm-hmm.
So a lot of beneficiaries are, in their 60s, say mom and dad are deceased in their, 80,
Sure.
and the kids are in their 50s, 60s still working. And they don't want to put $100,000, $200,000, $300,000 of taxable income from their IRA or non-qualified non-IRA annuity on their next tax return. They just don't want to do that. It's going to shove them into the highest tax bracket or one of the
Mm-hmm.
highest tax brackets. So what the IRS will allow you to do is to transfer your annuity claim to a company that is filed to create this non-qualified stretch payment over the life expectancy of the beneficiary. So if you've got a brother and sister and they're different ages, they each get their own life expectancy payout. Now, I'm using the words life expectancy carefully here. It's not a lifetime income, no matter how long they live. Say the beneficiary is 60 and they have a 23-year life expectancy. It's 23 annual payments or 23 years of monthly payments
Okay.
that come from the annuity that are contractually guaranteed that spread all this taxable interest out into the future. So you anticipate as your income's down that your tax rate might also be down. Ever since I've been in the business, all we've talked about is tax rates have got to go higher. Tax rates have got to go higher. I'm starting to believe that now with as much
Yeah.
stimulus as that. But anyway, bottom line, Stan, is that yes, you can take this beneficiary money, not put it on their tax return, and spread it out and earn interest during the process.
So give us an example of that. So let's just say that the parents are 75 each. They die in a fiery Learjet crash, and the kids are 50. So the kids, what do the kids do? They find out all of a sudden that mom and dad had this annuity. Now what? What do they do?
So let's say there are two kids. One kid says, I want my half in cash right now. And that kid ends up paying a bunch of tax. The other kid said, I'm still working. I'm successful. I don't want to take this money now. I don't want to pay the extra tax. So they enter into this non-qualified stretch plan and then have the money transferred during the claim process over to the new annuity company. And they can put that in either an immediate annuity that pays out over this 20 some odd years.
The life expectancy. Yeah, whatever that life expectancy
or Stan,
is.
they can put it into an accumulation annuity
Okay.
and pull out the equivalent of an RMD, required minimum distribution. So they're not forced into a payment stream per se. They can just take a withdrawal and let the money grow over time.
And that required minimum distribution would be based on their life expectancy.
That's right. And it's the old Table 1 IRS chart that was always used for non-qualified, IRA beneficiary payouts to non-spouses. And under the Trump administration, in the Secure Act, the stretch IRA was basically eliminated.
Yeah.
It used to be life expectancy, as you know. Now it's a maximum of 10 years. But we're still using annuities in that situation.
How about for spouses? It didn't change.
For non-spouses.
For non-spouse. For spouses, they can still stretch it.
A spouse basically can become the owner of their deceased spouse IRA. So it just becomes theirs, and they take it out under RMD when they hit age 72.
So for all the people listening and watching this that are 50 and 60, and going back to this example, and they find out that mom and dad had this annuity or annuities, plural, they're going to call the carrier, or hopefully they're going to call me, or they're going to call you at lenzfinancial.com. What's the next step? Because I think there's a lot of people out there going, wait a minute, I think mom has an annuity. I need to get my ducks in a row. Who do I call? Are they going to call the carrier that issued the policy to the mom, or are they going to call me and you and we're going to help?
Yeah, both ways. It's not uncommon for the son or the daughter to go through mom or dad's things, and it's that sad thing about looking in bank accounts, and all of a sudden they find an annuity from an insurance company. They don't know what it is. They don't understand it, and sometimes the agent is no longer in business, so they often call the company. Companies are pretty good now when they send out a claim kit to say you've got more than just a lump sum option.
Yeah.
But if the advisor is still there and understands the business, you're going to get some,
Ooh, that's a tough one. Did you just say understands the business? Whoa, slow down, John. Slow down, John.
And we joke about that because this business can be pretty complicated at times.
Yes.
It's not rocket science, but there's some nuances and tax regs we got to follow.
Yeah, it's not rocket science, but you need to know where the switches are, right? I mean, you do need to understand how the rocket's built a little bit. Final segment, because I mean, we could roll with this all the time, and certainly we're going to have John on again. And when we have him on, we're going to do a lot more detailed planning type examples, even though he's done that here. But yeah, you can one more time. You can contact John at lenzfinancial.com. Tell him that you listened to this wonderful Fun with Annuities podcast and it tweaked your interest on a topic, and he certainly will help you. You can call me as well at theannuityman.com. John, what's your overall outlook for the annuity industry? And when I say that, it's somewhat of a loaded question, but with 10,000 baby boomers hitting age 65 every single day, I call that a demographic tidal wave. I mean, it's thousands of people every day looking for contractual guarantees. And in my opinion, I think the annuity industry as a whole has dropped the ball from the standpoint of not reminding people these are contractual guarantees, and not reminding people that this is where you go for lifetime income, because that's the monopoly that only the annuity category can provide. I know that you're a glass half full guy, and I'm the curmudgeon glass half empty, can't find the glass. What's your thought on the annuity industry going forward, say in the next 5 to 10 years? What's going to happen, in your opinion?
Let me rub my crystal ball here a little bit.
John has the Tell Us Savalas look. Go ahead. I'm sorry.
So I don't predict the future really well, but having been at it for 40 plus years, the industry is healthy. It's trying to innovate in a difficult environment because
Hmm.
interest rates are so low. I mean, the
Right.
10-year Treasury bill while we're taping this is what, between 150 and 160. So you end up with 1.5% on 10-year money with the U.S. government. So nobody's interested in 1.5%. So the industry is having to go out, and invest this money safely and meet their regulatory requirements and still deliver something positive to the consumer. So, you are about guarantees, and that's, one of the things that drew me to you early on, because there is a lot of razzle dazzle in the annuity space, stuff
No
that
doubt.
you and I would never buy or recommend.
No.
But annuities provide this excellent layer of income protection. And if insurance companies stick to their knitting and remember what they're best at, that it'll be a healthy environment for them.
Do you see a lot of consolidation on the horizon? And if so, is it consolidation within the industry, or is it the hedge fund, private equity, big money people trying to get in the way of this demographic tidal wave?
It's both. There's always been a lot of merger and acquisition inside of our industry where, insurance companies are buying other companies for scale and size. And then over the past 10 plus years, there's been private equity entered our business in a very big way. I
Hmm.
think they believe, and maybe rightly so, that they're better at investing, and their the track record shows it's pretty successful. So there's lots of big names out there. But again, in my view, if you want something that's guaranteed for a lifetime, and you're 60 years old, and that might be 30 or 40 years, you want a big, strong company that's going to be there. It's not the highest payment each month. It's that you sleep at night knowing that payment's going to be there every month as long as you're alive.
I always tell people that life insurance companies aren't smarter than banks, they're just more regulated. Can you expound upon that? I mean, do you agree with that statement?
Oh, I think both industries are highly regulated. I just say that life insurance companies and annuity companies, let's speak, if you send $100,000 into an insurance company to buy an annuity, they have to reserve for that entire $100,000 being withdrawn at any time. So they've got to
Day
put up
one. You're talking about
day
day
one.
one.
Yeah, when an insurance company gets your $100,000, they've got to buy something safe that matches up with the time horizon that you've selected with your annuity. For instance, if you bought this 3-year MIGA, the multi-year guarantee CD lookalike annuity, the
Sure.
insurance company's got to have that money liquid in 3 years. That's not going into the stock market or real estate market. It's buying, high quality bonds, baskets of mortgages and whatnot. And so the industry has big reserves on top of the actual money they've got to pay back to you. They've got to add up some additional money out of their capital and surplus to create an additional reserve over and above what they owe you. So yeah, the industry's highly regulated, and that's why you've seen a lot more bank failures than insurance company failures.
No, I agree. And these investments, I always tell people, they're not just picking and choosing at random. Kind of explain the parameters and the restrictions on what annuity companies, life insurance companies. By the way, life insurance companies issue annuities, so that's the reason we keep going back and forth with that. What are they allowed to buy?
Well, again, I'm speaking broad
Yeah,
terms.
broad.
I don't work inside an insurance company, but an insurance company has to buy quality debt instruments generally. So corporate bonds, government bonds, mortgage-backed securities, things that can be readily converted into cash if the
Got it.
annuity owner wants all of their money. And of course, the insurance companies are already structuring payment streams to people, so they know they're going to need to be paying out money. They know people are going to die. So, you might look at what they're not buying, and they're not buying risky equities. They're
Hmm.
not buying junk bonds, only in small amounts, and then they have to add additional capital and reserve for junk bond purchases. They're not buying as much real estate as the industry has historically. And I was going to say they're not buying Bitcoin, but I did see the other day an insurance company did make a Bitcoin purchase with a nominal amount of their
Really?
investment. Yeah,
That's interesting.
yeah.
I just did a podcast on Bitcoin and cryptocurrency with a person that totally knows the blockchain technology, and we went through that. That's an interesting, and obviously they're going to have to reveal that, and people can look at that as well. Other than interest rates being a big challenge, what do you see the other challenge as a whole, or if there is one, for the annuity industry?
I'd say regulation is a challenge for the industry. I'm not troubled, and I know you're not troubled by regulation.
No.
Compensation disclosure, making sure clients have adequate liquidity.
Mm-hmm.
We're moving towards the fiduciary standard. We're at a suitability standard today.
Sure.
So I'd say regulatory is a challenge for the industry. Low interest rates are undoubtedly the toughest challenge for the industry right now.
Mm-hmm.
Distribution is an issue. There's a lot of old guys like me with insurance licenses who are going to be retiring at some point.
Yep.
And there's people like you that have just, come out in storm and said, deal with me directly.
Sure.
Insurance companies are trying to go direct to the consumer and have done so in some places. I'd say like any other industry, there's certainly challenges going forward, but big companies that offer these products are making money and delivering value to their clients.
Yeah, and I'm a firm believer in the direct-to-consumer model. In fact, pioneering it out here myself at theannuityman.com. But I think this podcast proves that you do need experts to talk to you about how to do this and how to do this right. The education level on annuities as a category, and there's many types of annuities, is lacking. John and I both believe that education on and learning about these products, both good and bad limitations and benefits, is the key to making a good informed decision on your terms and your time frame. And you have to understand you're buying a contract. So you have, understand the contract. But we've gone a long time. This has been great, but you're going to be back, right, John? I'm holding you to this on air. So, we definitely want you back. And remember, you can reach John at lenzfinancial.com, Lenz financial.com, based in Portland, Oregon. He's not rioting. I can vouch for John that he has not been rioting downtown. We love Portland. It's a beautiful city. Any closing remarks, John, before we say goodbye to everybody?
No, I'm good to go. I'd love to do this again, Stan. We can drill down a little bit deeper. I know the annuity world in general is accumulation.
Sure.
But there's all this ancillary business on the outside where annuities make a tremendous amount of sense. They're endorsed by the government, literally in their planning. So yeah, I love it. It's been good business for me.
Well, that's fantastic. I really appreciate everyone joining us. We'll see you next week on the #1 annuity podcast on the planet, where our saying here is living the reality, not the dream. My name is Stan, the Annuity Man, and we'll see you on next week's Fun with Annuities. Thanks for listening to Fun with Annuities. Please hit the subscribe button and make sure to go to my site at theannuityman.com, where you can run your own SPIA, DIA, and QLAC quotes and see a live feed of the best MIGA fixed rates in the country, and even get indexed and income rider quotes as well. You can also sign up for my 6 annuity owner's manual books, and I'll ship them for free and under no obligation. I also encourage you to schedule a one-on-one call with me, Stan the Annuity Man, so we can have a full discussion of your specific situation. It will be the best brutally factual and truthful advice you will ever get, and that's one guarantee you should definitely take advantage of. So join me next time for the #1 annuity podcast on the planet, Fun with Annuities.